With that, we are now moving on to our next session, a strategic look at asset management and distribution. Well, the mutual fund industry has been steadily doing well by adding more investors and accumulating higher assets under management. And today we have with us Mr. Sunil Subramaniam, MD Sundaram Mutual Funds, to share his perspective on the potential for asset management and distribution businesses in India and his reasons for the optimism. Before he joins us on stage, please allow me to give you a brief introduction. Mr. Subramaniam joined Sundaram Mutual Fund in September 2005, and during his tenure here, he has handled various roles before being elevated to his current role as Managing Director. He is also on the board of directors of Sundaram Asset Management Singapore Pte Limited. Under his leadership, Sundaram Mutual has won several prestigious accolades: the Economic Times Iconic Brands of India 2022, the YouTube Creator Studio Silver Award from Google for reaching over 1 lakh subscribers and sharing original content on YouTube, and the Tamil Nadu Best Brands Award 2020, the Innovative Launch Campaign Award for Sundaram Blue Chip Fund by the World Marketing Congress 2020. These are just few of the things that I'm sharing with you, and we're looking forward to this next session. So ladies and gentlemen, please, would you join me in welcoming on stage Mr. Sunil Subramaniam.
Good morning. That was a hard act to follow. And the word strategy is the most misused and confusing word. So when Prem told me that I have to do this, but then luckily for me, I find that one, Prem set the stage by putting out those numbers. So what does strategy mean? Strategy means to provoke, to encourage, to aspire, and to support. And that's what I'm going to try to do, to set a logic for this 100 lakh crore target. What do we need to do? And ultimately, I'm going to end it back by turning the focus on each one of you here, right? And that's what you need to do to make the industry achieve this, right? From that perspective, right, let me first tell you the state of the industry is at. Prem spoke about it to say that it's 39 lakh crores. We have 55,000 crores, 55% in equity, 12 in hybrid, 12 in fixed income and liquid. So from this perspective, what growth can we attribute and when can we expect to reach 100 lakh crores? So for this, I know Prem said 2030 Amphi has decided. I beg to disagree, and you will come to know why, right? Let's look at the past growth rate of equities for us, right? So the first thing is that let's understand the composition of our industry. That's one of the most critical. So pure large cap funds, which is ETFs, index funds, plus large cap active managers, 37%, and non-pure large cap, because as we know, outside of large cap, flexi caps also put most of the money in large caps, right? So the way I've defined it for a particular purpose is then to look at the past growth of the industry. And you see the most confusing stats here. And that's the reason I put this up. So this is the growth of the Nifty, the light blue line here that you see. And if you take 5-year CAGR, 10-year CAGR, 15-year CAGR, they throw up completely different numbers. And when you then go and look at it, what do we tend to do? So we look at this 10-year CAGR and do that. The fact is, in certain 5-year periods, the industry has been flat. So how do you go about choosing in this journey, Prem said 2030, which is the one that's going to come through? That's the challenge before us. So from that perspective, right, I just wanted to tell you that this growth that you saw here, right, 8 to 20, if you look at it, that's the period that the industry actually from 8 to 20, from here to here, has one of the highest growth phases in a time when earnings was only 4% CAGR. So clearly, the market has appreciated much faster than the earnings. We all say economy will lead to the thing, right? So what's the reason for that? The reason is none of us here. The reason is that Gora Admi sitting outside India, who's been giving a valuation premium for the last 15 years to a market. This is a world market, and that's the emerging market, and that's India's premium. Why are we getting this premium? It's because we have been the best emerging market from a foreigner's perspective. That yellow line is the premium for India versus all the other emerging markets. And the reason for that is because we are the most favored. We are the darling child of the FIIs. If you look at the last column from 2012, barring 1 year, we are the only country every year to have got allocations from FIIs, as a result of which today, FIIs own, even after the correction, 40% of the free float market cap. So whatever we think about our future, can't do it without thinking about what that guy is going to do to our country's stock market. So what is that guy going to look at? Now there, if you look at, you can see that in the MSCI Emerging Markets Index, right? We are today 15% of the index, China is 31. But if you read the stuff there, you'll see the growth that India has achieved. So what I'm trying to push here is that the foreigners are seeing something about India, which we all don't care the same. So the first what I want to take is have an optimism about our country, because that's what the foreigners think about us. And if you look at it, what's the reason for all of that premium? It's the quantitative easing, that money floating around. There's $9 trillion of money from the US. There's $30 trillion of money from the G4 countries. India gets only $600 billion of that from a $30 billion pool. Because we keep worrying about this tapering, quantitating. You think that all that money is going to disappear in a hurry? No, it ain't. It may correct a bit, and India is a drop in that ocean. From that point of view, if you then look at it, and look at our valuation from our own self, right? We are bang on, right at the long-term average valuation. So it's my perspective that we are neither an overvalued nor an undervalued market. From that point of view, now when we come back, let's look at the broader market, right? This is a large cap story for the FIIs. What about this balance 63%, which is that? So for that, if you were to take a look, surprise, surprise, the Nifty and the NSE 500, absolutely bang on, our husband and wife married together. Why? Because every flexi cap fund manager is putting 80% in large caps. The index itself, the Nifty 500, NSE 500 index itself carries almost 80% large caps. So this is not what we should look at. What we should look at is the individual small, mid, and large. And there, as you can see, there is a valuation story which is different. Because for our perspective, what we need to remember, is if you split India into growth phases and non-growth phases, vicious cycles and virtuous cycles, mid and small caps always outperform large caps in virtuous economic cycles. So obviously that takes me to the next level of our story, is that what is our earnings? Because market is a function of valuation and earnings. You'll all be surprised to know that the broader market has doubled its profits under taxes in the last 4 years from 5 lakh crores to 10 lakh crores. So people who talk about recession and all of that, bear this in mind. And this tells you that why mid and small caps outperform is because they not only do better EPS growth in a virtuous cycle, they also get a fantastic valuation expansion by money chasing those stocks. So this, in order to set the base for fewer, so what is important, the growth look? Are we going to be in a virtuous cycle? From that point of view, you look at this, the word recession is eating our heads, investors' heads, our heads. Every time oil as a percentage of percentage of the GDP goes up, recession comes in. We know that the advanced countries are headed towards recession. But just look at this. This is the probability of recession across the world. There's Germany at this end, and there's India at this end. India has close to a 0 probability of recession, right? Next, look at the growth estimates, right, among the various countries. Thanks to this whole recessionary flow, every country is getting downgraded. India is flat right on top without a change, right? And yesterday, IMF released these stats. World output, they've corrected from 6 and 3.2 to 2.7. Advanced economies from 5 to 1. But emerging economies have also come down from 6.6 to 3.7. But India has gone from 8.7 to, so a post-correction, recession-factored world, India is by streets the fastest growing economy in the world. So from that point of view, right, what is this that's driving a longer-term growth story? Because we are looking at a decade ahead, right? So from that, let me quickly take you through the drivers. Government capex, the 111 lakh crore infrastructure program, the China plus one driven capex, driven by what? Driven by the fact that China's working age population is falling off the cliff. India's working age population is growing till 2050. So the labor force advantage that India carries is sharply captured here. This is the global labor force contribution. There's no country anywhere near. In fact, China, as I said, is negative, right? So we are the labor powerhouse of the world. Second, Per capita income, right? China exploded from 2,000 to 10,000. India is at 2,000. What does it mean? It means Chinese labor is 4.5 to 5 times costlier than Indian labor, right? That's the second point which is driving the fact that US CFOs, when they surveyed, when you move your business out of China, India features right next to Japan as that country where they want to move their business. Then, even within China, the Chinese manufacturers are aware of their own problems. They want to move outside, and there also India features despite Galwan. Okay? So from that point of view, that's why the PLI scheme the government has launched to take advantage. And if you see, there's almost 2 lakh crores of capex from PLI coming through in the next 18 to 24 months. Apart from which, FDI flows into India have been consistent and rising, which means that PLI is driving that partly. And private capex, because our capacity utilization is today at a 17-quarter high, and we have crossed our long-term average, private sector has started investing in capex again. I'm sorry, this is not working. Right? And for 10 years, private sector has spent a diddly shit on capex. 1% capex. So there's huge amount pent-up demand on private sector capex happening, and hence private sector capex is going to shoot up to 14% of GDP. Our manufacturing is going to triple or quadruple in size depending on how well we act on this opportunity, and manufacturing as a share of GDP is going to hit 20%. As a result of this manufacturing, discretionary income is going to drive what? Whenever a country crosses $2,000, which is where India is, they just explode. So Korea went from 2,000 to 28,000. Malaysia went from 2,000 to 11. China, you saw, went from 2,000 to 10. So in this process, what happens is that we are only expecting India to go from 2,000 to 5,000. Let's not overreach ourselves. But even with this kind of a modest doubling of a per capita income, you're going to see a massive shift in the income mix of the population from the strugglers to the elite. And what you're going to see is that by the end of the decade, 50% of population is going to come from the top 3 categories, which is super rich, rich, and the upper middle class. So that naturally is going to drive a massive discretionary consumption expenditure. What does it mean? A struggler spends half of his income on food. A super rich spends only 14% of his income on food. So as people move up this value chain, their income chain, the quality of their consumption goes from FMCG to discretionary consumption, and naturally, the people are going to finance that is the banking system. So the services industry is also going to explode. So as a result, if you then take through the end of the decade, you're going to see something like a 12% CAGR driven by manufacturing, consumption, and services driving our GDP growth. So I hope the confidence behind our growth has come, the basis on which India, as you know, has just overtaken our rulers and now overtaken France to become the 5th largest economy in the world. And in our sights are Japan and Germany, not too far away. Yes, USA and China are way ahead. It's some time to go. But this is a story that FIs are betting on India. And hence, now when you see the stock market directionally tax nominal GDP. So if you expect the GDP to grow at a certain rate, you can expect the stock market to follow suit. So from that point of view, back to our slide. Now, which number do you want to choose? Based on what I said. You'll all say, let's choose 19%. Right? I'm not going to do that. Let's not overreach ourselves. What am I going to choose here is I'm going to choose that was the stock market. We are talking about mutual funds. So we have some alpha to plan for. So all I'm saying is that the large cap funds will grow at 13%. The mid and small cap or the non-pure will be at 15. Mid and small will grow at 18. But since we have flexi caps, which are 80% large cap, that will tone it down. So based on these extremely conservative assumptions, I'm assuming that equity mutual fund basket will grow only at 14%. I hope there's confidence that that number will get achieved. And hybrids, because they carry only 60, 70% equity, will grow at 11%. Basis those assumptions, our mutual fund industry, right? I have assumed that fixed income will grow at 8%. Interest rates are rising. They should beat bank deposits. So bank deposits at 7-ish. Fixed income should be 8. And liquid funds should be at 4. So these are the base assumptions for this forecast. And my dear friends, this is what AMFI has done. AMFI has just projected this kind of a growth so that in year 9 is when we'll achieve 100 lakh crores. Right? So AMFI is projecting. That's why I said today I'm here to provoke. Are we going to be satisfied with this? Right? Because in my mind, this is a do-nothing strategy. We are not here to do nothing, right? We are here to do something. So what is that? Because we are just scratching the surface of the potential in front of us, my dear friends. What is that? This is MF assets as a percentage to GDP. We may be close to nil recession, but you're almost close to nil MF penetration. Right? So it's a glass half full, glass half empty story. You can look at this and say that all of us have done a pathetic job. But you can look at it and say that we have a phenomenal future lying ahead of us to catch up with any of the Western world. That's a 3-minute trigger for me. So, right? So, basis this, obviously there's a huge potential, but what does it require? Just look at this chart, and that will tell you even more misery upon ourselves as a half-empty glass, but look at it from full. This is the yearly gross savings in India. The red is the financial savings, the gray is the physical savings. As you can see, physical dominated earlier, now finance has begun to dominate. But within finance, dear friends, search for mutual funds. Where is it? Right at the bottom. We get only 2% of the share of a gross household's financial savings. What are we doing in our daily lives, my friends? That's there. There's so much huge potential. And what is going to be the future? This 60-40 ratio, how is that going to go first? So if you then look at it, there's a strong correlation. First of all, take household financial assets as a percentage of total financial assets. Whereas India, again, we are defining the bottom end of this curve. Right? So the situation we are in today, right? We have so much potential to grow household financial assets as a share of the total financial assets. And this tells you the answer, that when there is high inflation, physical savings dominate. When inflation trends down, financial savings dominate. So what is our outlook for inflation? In a recessionary world, commodity deflation is going to happen, and so inflationary pressures have already begun easing. So which means the stage is set for financial assets to even increase their share of total assets in the years to come. Right? Pardon me, I'll just take a couple of more minutes. Okay? Right? So that's what I wanted to write here. So from that perspective, this chart, which I already put up on per capita income, I talked about discretionary consumption. But when per capita income rises, what also changes? Discretionary savings. So you are going to see a doubling of per capita income. Part of it he will spend, part of it he will save. That pool is also rising. So nothing could be better for us. And when our per capita income went from 1,000 to 2,000, doubling, the banking system tripled. So if this is going to go double from 2,300 to 4,000, you can expect what's going to happen to the banking system, which represents our main area of opportunity. So the time is ripe for our industry to increase its penetration massively. And what do we need to do? We need support from all stakeholders, the AMC industry, distributors and advisors, and regulators. And let's look at this now. First, what is AMC I feel we need to? We need to first simplify our products. That's why we are so low in market share. We have complicated the hell of life for the investors. So minimize that sexy flavor of the month product launches. Focus. Avoid taking excessive risks in non-sectoral funds. Use beating benchmark as a primary tool for a fund manager's appraisal. Move to communicating risk-weighted return as opposed to just past performance. Swallow the poison pill. Migrate towards one PAN, one industry folio. Let a inter-AMC redemption and purchase just become a switch transaction first, right? Then you also need to support the distributor fraternity with a heightened level of customer connect during volatile times. It's the industry's responsibility. We have to reach out to the customers of the distributors and comfort and calm them. And sad to say that 1 basis point is given to AMFI for that advertisement campaign. The 1 basis point that remains is still used mostly in hoardings, and I'm also guilty of this. But if we did that, can we do 5 to 10x of actual ground level investor meets of awareness? That's there. Because with a 2% share, we have a 98% of the industry to convert. So from the industry, I think these would be the great helpers. And for distributor advisors, first, on your existing customer, you have to increase your share of wallet with every customer. How? First, you have to win his complete trust and position yourself as a life financial coach. I'm carefully choosing a word which Sebi has said you can't do or not do, right? You can all be either you're an MFD or thing, you can be a life. And then you also got to swallow the poison pill. Advise him on his bank deposit. Give him advice on which bank to do, what to do. Take that. It's zero revenue for you. Then add on stuff like writing estate planning, use partnership effectively, number one. Second, become a master of technology and not its slave. Everybody today dumps updates on the investor, and WhatsApp University has become the most popular university in the world. Eschew that, please. Customers don't want that. Next, obviously, you have to skill yourself in knowledge. When you talk to a customer, right, don't let it become a missed call that the customer doesn't want to take your telephone. Next is use, like I said, leverage to reach your customers. I said this there also. And create and communicate an obvious succession plan. In fact, persuading your kin to join the business, because what happens after you is important to a customer. So do not ignore that at all. And the second one is for new customer acquisition. Again, I'll not go through too much. I'm just writing it up here. It's all the same standard stuff. But for me, this is a huge opportunity which has just come. Post-COVID, these young IT engineers, hot button, Robinhood investors, who today are scared because of the volatility, is a fertile hunting ground for you to acquire new customers, right? And as far as the regulator is concerned, I think this is the support we need from the regulator, right? First, can they liaise with other regulators to make it a level playing field for our industry, right? That's number one. Number two, can they create an MFRDA to focus on the regulation and development of our industry and not let us get lost within the overall capital markets universe? The third, can you introduce or eliminate or reduce this conflict of interest? An AMC body is trying to regulate and discipline the hand that feeds. It's a fundamental contradiction. Huh? I'm expecting you to do business and I want you to regulate you. Chalta nahi hai bhai. This has to change somehow. I don't know how, but it has to. Then, check writing from mutual funds. In all other advanced countries, a mutual fund manager guy can write, an investor can write a check and transfer his money, right? And that's why there, the MF industry is equal or larger than the banking industry. This will be one of the biggest steps they can do to help us completely take care of the wallet. And income tax department is rewarding investors with Samman certificates. Why, as we, as the regulators, only looking at guilty until proved innocent? Can we look at it as a partner in progress? And can we start objectively, long-standing worthy MFDs, can they be given Saman certificates? And can they be put out in the public domain? So that this will go to a long way to encourage more youngsters to join this profession, right? So that's my pleading to the thing. So obviously, on this basis, I think that these are the kind of growth. This is the market growth. These are the kind of growths that we should plan and aim for as an industry and individually, each one of you. 10% increase in your customer base every month, the customer share of wallet plus new customer. 15 in hybrid because it's a close to fixed deposit. And the other one, in terms of fixed income and this liquid, I've only taken 2% because corporates are going to withdraw from mutual funds. It has to be retail which has to substitute. So if we do this, my dear friends, by year 5, we would have tripled our industry's base and achieved our goal by this. That's why I said I don't agree with Prem saying 28 September. I think September 27 is what we should target to achieve this. And right? The question is, do we want to be satisfied or can we try to double? Because if we do nothing, right, if there is no acquisition, in that 5 years, the industry will only grow 1.7. So all of your trail incomes will go up the 70%. But are we going to be satisfied or can we alter it? So I want to end with saying that, yes, we can. We have demonstrated a 13,000 crore SIP book, and whenever the FIIs was selling, they sold 2.5 lakh crores, we bought 2.5 lakh crores. We gave a strong thuppad to that FII, hot money FII, to make him regret his redemption decision. And hence, because of that, Indian market's volatility is lower than the world's market. For all the volatility that you are facing, we are far better from this. And this is India's decade. Each one of you must set a goal of tripling your business in the next 5 years. Jai Hind. Thank you.